Welcome everyone to the Capstone program for transfer pricing classroom to boardroom, the transfer pricing committee's mentorship program. This is our second annual event. It's our first hybrid one, our first super spreader event. So thank you all for being a part of that. Next slide, please. So we'll start with some preliminaries before we get to the meat today. I'm Liz Stevens. I'm one of the program leads. Nirja Srinivasan and I created this program last year, and it has been quite the ride. This year has been much grander and bigger in scope because we've been able to introduce this in-person element. But Nirja is the incoming chair of the transfer pricing committee. I should mention that. So buckle up. And this year, we were joined by Iman Filer, who cannot be with us today because she had a baby about 5 seconds ago, but is of course on Zoom. Iman has really been absolutely indispensable, and I'm so sorry that she's not with us, but we're super grateful to her. All of the effort that she's put in over the course of the year, particularly keeping in touch with our mentees. So the agenda today, number one is what I'm doing right now. We'll give you a quick overview of what the program is, who these folks in the conference room sitting around me are, and the case they are about to tackle. Then we'll let the taxpayer team present its case. The US Competent Authority team will go next, and Indian Competent Authority will round it out. We'll then take a break, let the teams go off to their corners to refine their negotiating strategies before we all come back in here. And we'll have a live Competent Authority negotiation, hopefully with a resolution that's sort of arm's lengthy. And then our taxpayer team will have an opportunity to either take it or leave it. Thereafter, we will have more of a realistic view from our expert panel, who Nirja will introduce momentarily. And then we'll have a networking session for those of us who are here in the room. So next slide, please. All right, so what is TPc2B, this weird acronym? Transfer pricing classroom to boardroom is the name we came up with for our mentorship program, pairing in-house corporate mentors. These are tax and transfer pricing professionals working in multinational corporations with law students, and hopefully at one point, students of economics and finance as well, to kind of introduce them to transfer pricing, hopefully get them hooked. We have been successful this year with some of our mentees who will be going on to work in the field, so we're very excited about that. This year's capstone is a mock US India Competent Authority negotiation. It is the kind of the culmination of the year. So the students have met with their mentors rather, periodically throughout the year, generally on Zoom or on the phone, talked about transfer pricing topics, talked about careers in tax, talked about, the weather, baseball, whatever they felt like talking about. And then eventually they started talking about this capstone and, getting some advice and tips from their mentors on how such a case would really play out, in the real world for a real company. We are very proud of this program, and I will turn it over to Nirja to continue.
Okay, thanks, Liz. Why don't we go around first and have the mentees introduce themselves, just really quickly, your names, your school's affiliations, of what, if you have an interest in transfer pricing going forward, maybe about 10, 15 seconds each. Can I start with you?
Of course. I am Hannah Welch. I currently am a JD student 2L at Texas A&M University School of Law. And I have, this semester, I actually had a transfer pricing class with Professor Burns, and it was very interesting. And overall, I'm hoping to work in international tax, and transfer pricing just seems to be a great place to be. So.
Hi, everyone. My name is Wei Bin Tan. I'm a tax LLM student at NYU. I'm also very interested in international tax and transfer pricing. And before my tax LLM, I worked for about a year in this field in the law firm in Canada. So very happy to be doing this exercise today.
Hi, my name is Felipe Restrepo. I'm a foreign trained lawyer. I'm actually doing the tax LLM at Georgetown. And I'm pursuing the certificate in international taxation, which is why also transfer pricing seems like a really good path.
Hi everyone, my name is Pablo Góngora. I'm a tax lawyer from Chile. Before coming here, I had my practice going on back in my country, and right now I'm doing a program on international taxation back at the University of Florida. Transfer pricing was one of the issues that was of my most interest when I applied here. So the program has been an incredible opportunity, and had a class there too. And my field after this is gonna align with transfer pricing. So I'm very happy and grateful for the opportunity.
That's great. And I have to say, Pablo, Felipe, Webin, and Hannah are going to be the Indian Competent Authority team. Okay, let's move to, is that the taxpayer team at the end? Yeah, go ahead.
Hi, everyone. My name is Dara. I'm also a foreign trained lawyer from Nigeria. I'm doing my tax LLM program at Georgetown, and I'll be graduating next week. And
Congratulations.
So I have a lot of interest in international tax. I am also taking the international tax certificate, and this program has really been very important and helpful in following my classes. Some of the classes that I've taken, I took transfer pricing last semester and international tax, and some of the discussions I've had with my mentors have really helped me to understand some concepts and how these things work in practice. So I'm very happy to be here, part of this. Thank you.
Super. Let me ask the rest of the taxpayer team that's down in virtual, in the hybrid format. Go ahead and introduce yourselves. Let's start with Lily.
Hi everyone, my name is Lily, and I'm at the NYU taxation program, and it's going to finish this May. And I've been taking the transfer pricing class at NYU as well. My professors are Mark Levy and Steve Rapp. I've learned a lot from them. At the same time, I would like to thank my mentor, Deborah Toluto, and I definitely learned a lot of practical stuff from her. And I'm really glad to be a part of this the whole mentorship program. Thanks.
Sounds like Ashley, you're right there.
Oh, okay. Hi, my name is Ashley. I'm also at NYU doing the International Tax LLM. I previously worked in transfer pricing for about a year as well. And this year I've learned a lot about the practical side of transfer pricing in the US and how things work here. So it was very eye-opening. I would also like to thank my mentor for all the time and effort she put into the meetings. And I hope to be involved in this field in the future as well.
Super. Thank you, Scott.
Hi, everybody. My name is Scott Cundy. I just graduated last week from the University of Kentucky College of Law. I have a great interest in tax, and I've enjoyed my time taking classes, clerking on the tax court and whatnot. Although I have accepted a position doing corporate finance and restructuring for the time being, I hope to come back to tax maybe in the next few years.
Congrats.
Hi, everyone. Good afternoon. I'm Chooks, or Koyekwe Chooks. I'm a foreign trained lawyer trained in Nigeria. I'm currently a grad student at the University of Florida in the International Tax Program. I must say that the mentorship program has been really impactful, given the fact that it has afforded me the opportunity to have an hands-on experience on what or how TP practice is here in the US. Particularly my conversation with my mentor basically showed that there's so much to TP than what's in the books. There's so much to learn, there's so much to do. And I anticipate that going forward, I'll definitely have so much, I'll definitely put in all that I've learned so far into my practice in international tax going forward. Thank you.
Fantastic. Okay, let's move to US Competent Authority team.
Hi, my name is Carolina Figueroa. I'm also a foreign trained lawyer. I'm from Chile. I'm pursuing my tax LLM in Georgetown Law. Also, I'm pursuing the International Taxation Certificate. I got actually interested in transfer pricing my first semester taking a class, and thanks to my mentor, and I will say friend already in this point. I hope he say the same. I got like really interested in the area. I already accepted a position in transfer pricing. So, well, thank you. You for sure like play a very important role in my incipient career in transfer pricing.
Hi, my name is Brandon Cato. I'm a tax LLM student at NYU. Just finished my last exam. I practiced for about 8 years prior to entering the tax LLM program. So becoming a tax lawyer is kind of a dream of mine. I'm very interested in transfer pricing, not going into the field immediately, actually going into state and local, but there's a good chance that I will transfer into the field sometime in the next couple of years.
Sorry.
Yeah.
All right, Enrique?
Yes, hi, good afternoon. My name is Enrique Aniquino. I'm also a foreign tax lawyer from Brazil. I'm finishing the LLM in International Taxation at University of Florida. And I accepted a position to work as an international tax consultant after the completion of the LLM. And I think this program, this mentorship program, was a great opportunity for me to learn about transfer pricing, and I'm sure it's going to be very useful for my career in the future. Thank you.
Hi, everyone. My name is Michael Splendor. I just finished my 3L year at the University of Minnesota School of Law, and I was just really interested in this program. I worked for an accounting firm doing transfer pricing stuff last summer. I was glad to be able to have the opportunity to expand on that and get some real practical experience. And I really appreciate everyone's work on this program and, my mentor as well. So thank you.
Okay, and let me quickly mention the mentors. And yeah, I just want to quickly run through the list of mentors that we've had that have put time and effort, and you guys all know that, and really, leaned into the program and have made it what it is. And so we're very grateful to the folks for giving their time and interest. Ognian Stoichkov, Mark Colabella, Jess Arthurs, Liz Chien, Terry Ziachik, Joel Wilpitz, Dave Paul, Deborah Toludo, and we're happy to have Deb in the room here, John Palmer, Azadine, Nabil Anwar, Catherine O'Brien, Wade Owen, and Abhinav Mehta. So just quickly, I would invite everyone to just give a round of applause, both for the next. Okay, and then the next slide, our expert panel, and we're really looking forward to what they have to say about this case and their experience. Howard Berger, Special Counsel, Covington and Berlin, David Farhart, who's at Skadden Arps and specializes in transfer pricing controversy, and Pat Lewis, who's Senior Counsel at Kaplan and Drysdale. So thank you very much to the three of you for being here, and we're really looking forward to everything that you have to say. Thanks also to the Transfer Pricing Leadership Committee and the Teaching Tax program that is co-sponsored this particular session. And of course, to DeMarcus, our Zoom ninja, without which we would not be able to be virtual and hybrid and all of those wonderful things. So let's go to the next page. So I want to introduce the case in brief for those who are not familiar with it and who joined the audience recently. Our case is a US multinational. We've made it very simple. So you have a US company headquartered in the United States, but with a wholly owned subsidiary in India, India Co. India Co does all the manufacturing for both the US market as well as the local market. And India Co has been assessed lots of transfer pricing penalties over many years. And the audit years that we're looking at is 2017 through 19. And the taxpayer, after many years of dealing with controversy and assessments, has finally appealed to the MAP process. So they're going to MAP, to the Indian Competent Authority and APMA, and basically saying, well, here's our case, we need resolution for the prior years. At the same time, they've decided that they might as well, get a good deal going forward. So starting with 2020, they're looking for a bilateral APA, US-India APA. So they've come to compatibility for two reasons. One is to clear the back years through MAP, and going forward through a bilateral APA program, secure a good deal, which may or may not be the same terms as MAP. We will see, because that's what we're going to decide today. So with that, if anybody wants to see any more details about the case, there's a printout at the back of the room, and I think we can also append a file so that the online audience can see it and they can see the facts of the case. But you will hear more than what you need to know from the teams here today, present. So with that, let's go to okay, we have a disclaimer, and great, and then we move to the next page. So let's start with the taxpayer team. The taxpayer team is going to make a pitch for why the tax return position is at arm's length.
All right, well, good afternoon, everyone. Thank you for joining us. Again, my name is Scott Cundy. I'm acting as an attorney on the U.S. taxpayer team in this exercise. As was just mentioned, we're here today because the Indian Competent Authority has made adjustments to 4 separate transactions that we have between our U.S. company and our Indian subsidiary. As was just said, our U.S. company is in charge of the designing and manufacturing and selling of luxury leather goods. So the U.S. company handles kind of the high-level management, logistics, and design responsibilities, while the Indian company focuses on just the manufacturing. The Indian company also does sell the goods within the Indian market solely. So the Indian Competent Authority believes that the India Co. is bearing a greater portion of the overall risk in this business venture, and therefore they believe that India Co. should be allocated a greater portion of the profits. So now I'm going to just pass the time over to my other colleagues, and we're going to go through each transaction one by one and state, describe and discuss and defend our position as to why we've chosen the transfer pricing methods that we have. Next slide. And next slide. And next slide.
All right, thanks, Scott. My name is Lily. So the one I'm going to talk about the transaction number 1. And as you can see from the slide, transaction number 1 relates to the contract manufacturing services provided by India Co. to US Co. As a member of the taxpayer team, I believe that the comparable profits method is the best method for this transaction, largely because India Co. is a contract manufacturer who actually performs all the routine manufacturing functions. We don't think it is proper to call it itself as a full risk manufacturer. Our determination of India Co. as a contract manufacturer is based on the functional and risk analysis we did. If you take a look at the slide, the functional profile, pretty much you can see that India Co. does all of the manufacturing of luxury leather goods, and it is also responsible for the quality assurance. But it is, as a matter of fact, it is US Co. Pretty much performs all supplier development and roughly 3/4 of the purchasing and managing of the materials. So in that sense, when we were looking at the risks, next slide, please. Sorry. So when we're looking at the risks, and we'll see clearly that pretty much there's simply no basis for India Co. claim itself as full risk manufacturer. First, US Co. shouldered all the full risk for the research and development, production, and the majority of the market or marketing risks, inventory risk, warrant, product liability, etc. And also from the table, you can see the only risk that was fully given to India Co. was the risk associated with fixed assets investment. And it is just natural because India Co. is the manufacturer, it's the contract manufacturer. And it is the manufacturing party who actually manufactures the products in its facilities. So when we examine the whole picture, we can see very clearly, from the perspective of its functions, assets, risks together, all the combination puts Indiaco perfectly as a contract manufacturer. So based on this consideration, we decided that pretty much, the CPM is the best method, because as we all know, that method is typically used for manufacturing entities. So that's why we use the CPM method. And then for the next part is looking at our comparables, is why we used our comparables. The same way, when we're looking at the CPM method, the comparables typically are more focused on those functions. When we're looking for, instead of just simply the similar industry, it'll be more focused on the functions. And then Indiaco functions as a contract manufacturer and does not bear those research and design risks. And that therefore the ones they pick, the comparables they pick, just simply not reflect the reality or realistic pictures, as well as what the comparables we picked. We also had a bigger pool of the comparables compared to what Indian Competition Authority picked. So based on all these, we think that our transactional analysis reflects the reality more accurately. Next.
So I'll just walk through this transaction. And this is the contract R&D services that Indiaco performs to USco. And if you look at the chart, we will see that the relevant functions, assets, and risks, if we aggregate them together, the US actually performs 65% of all functions, assets, and have all 65% of all the assets, and also take care of 65% of the risks. The only challenge in this instance would be with regard to the manufacturing know-how that appears to be borne, the risk appears to be borne by Indiaco, because there's this research and design center in India. Now, our position on that is that everything that's done with regard to that research and design center is under the direction of the USco. So the USco, they give instructions, information, they basically coordinate how that the manufacturing know-how came about. And because the know-how is not a legally registered intangible, what we really should be looking at to determine this would be who controls this process. And like I've already said, it's the US R&D team that gives direction, that gives information, that gives instructions to the Indiaco, and that's how the manufacturing know-how comes to be. And because of that, it's our position that the USco has complete control and, in fact, ownership, if we look at it that way, of this know-how. So even though it's taking place in India, the risks associated with it are borne by USco. This next slide. And based on this, we are of the opinion, or we are of the view, that the TPM to be used should be the CPM or TNM. And the reason for this is that when we look at the comparables, even if there are differences in terms of transactions, they would not necessarily impact the results, because the profit level indicators that we are looking at would be a return on total costs. And based on that, Indiaco would just be reimbursed at a cost plus markup, because like we said, the US controls and gives directions for the manufacturing know-how. So the bulk of the returns should go to the US, while Indiaco is reimbursed at a cost plus markup. And to even underscore that, if we look at the interquartile range of the comparables that we have looked at, the interquartile range is between 5 and 25%, with a median value of 10. And based on using this method, Indiaco has already been allocated profits of 15% which is 5% more than what the IQR median is. So to that extent, we think that the method works, and the numbers that we have already selected and submitted in our returns should be respected. And one last point on that before I hand over to my colleague is that the fact that we are using the CPM because we have agreed that, or we posit that there's one company that's making routine contributions, that's India Co. And then the other company, that's US Co, is making valuable or intangible contributions. And that's why this return should go 15% to India Co and 75% to the US to reflect the risks that they've done. Ashley, do you?
Next slide, please. Okay, so again, my name is Ashley, and I will be going through the third transaction, which is the payments made by IndiaCo to USCo for royalty in exchange for use of IP rights for the sale of its own products in IndiaCo's local market. And on the slide, you can see a few details of the comparability studies carried out by us, the taxpayer, and the Indian CA. One thing to note here is that the PLI used by both of us are different. First of all, we have used the royalty rate as a PLI, while Indian CA has used operating profitability. And this has led to largely different results in the IQR, and also Indian CA's suggested royalty rate of 1% compared to our 4% used. Next slide, please. So my first point here is that I'd just like to say that the FAR analysis, functions, assets, and risk analysis carried out fully supports our use of the royalty rate because, first of all, because of the assets analysis, the majority of the IP was employed by a US company as compared to minorities by the India company. Moreover, India company, while it does have its own marketing team, all of the sales strategy, pricing, and also majority of advertising is carried out by US company. And India company only does, mainly its functions a lot on it, like mostly does its own regional marketing plan. So it does receive a lot of support and a lot of support by the US company. Secondly, as I mentioned before, Indian CA used a different PLI from us, and arguably our use of the royalty rate as a PLI is much more accurate, since operating profitability includes a lot of other revenues and costs that are not related to licensing activities at all. So yeah, and moreover, they have used a sample of companies engaged in advertising activities, which arguably do not only carry out licensing activities. And so, yeah, all those other profit streams would lead me to say that their benchmarking is less accurate than ours. And this leads to the last point I'd like to make is that their suggested use of the suggested rate of 1% royalty is quite arbitrary, since it was not derived from their benchmarking study, and there is no guidance on no guidance given on how this was calculated from their benchmarking. Okay, next slide.
Thank you, Lord Ashley. Lastly, I'll be looking at the transaction 4, basically, which talks about management services. Our argument here basically is the fact that when we compare the relevant FAR, basically, despite the fact that IndiaCo has more staff, the operations by USCo is optimized, which in any way did not reduce the profit margin of the Indian company, and more so the fact that the markup charged by USCo is within the interquartile range also shows that due consideration was basically given for the factors utilized in pricing the management services and all that. And lastly, talking about the strategic services offered by offered by India Co to US Co, the argument that the strategic services basically is duplicative, given the number of employees and all that, would not pass the test of looking at the transfer pricing method used, because even the audit used by the India CA did not take into cognizance certain factors which US Co definitely took cognizance of, one of which is the benchmarking analysis that the India Tax Authority did. I hope that this argument of ours, we've been able to convince the competent authority from both sides to concede to our filings and give us favorable consideration in light of our presentation. Thank you.
Thank you very much, taxpayer team. I think we maybe didn't give a heads up to the folks who are on Zoom. Apologies, but we are keeping time for your 15 minutes. Yurja has yellow and red cards here. So yellow cards, which you may see in the corner of our screen, is 5 minutes, and red card is 1 minute. So watch out for that, those of you who are on Zoom coming up. But next up, we have the U.S. Competent Authority team, which will present its negotiating position, having heard from the taxpayer. Take it away.
All right, next slide, please. Yeah, my name is Brandon Cato. I'm an economist with the USCA team, but we did cram everything down into each of us take one transaction. So next slide, please. The taxpayer claimed that India Co is a contract manufacturer, whereas the India TPO office, and that should say full risk manufacturer instead of full service manufacturer, my apologies. If you look at the transaction itself, there's definitely something going on here. But as I'll try to demonstrate here, nearly 90% of the function of India Co is operating as a contract manufacturer solely. The other 10 to 15% is not quite full risk manufacturer, as we will show going forward. So a full risk manufacturer is generally responsible for product liability, warranty, capacity utilization, market demand, and pricing risks for about 10 to 15% of global sales that occur in India. India Co does appear to take on most of those activities, but if you look at the next point, the very last sentence there, generally engage in significant R&D activities. Once we present transaction 2, we hope to show that India Co is not generally engaged in significant R&D activities, and also has not shown or demonstrated any capacity to develop, maintain, or protect valuable IP. Next slide, please. The slide deck shows that all supplier development is done by US Co. And the taxpayer team argued that about 1/4 of the costs of the raw materials are actually borne by India Co. But as I'll show on these next few slides, I don't think that's the case. I think it's more like 1/7 of the cost. So if we look at the system costs for each year for which we have data, there's a jump in cost from 2019 to 2020 of $14 million. These are the other costs, because the only costs that are itemized are R&D and marketing costs. So these other costs would be something like management, labor, fixed assets, raw materials costs. Next slide, please. If we look at the other costs broken out by which company bears those costs, roughly 12.5 to 16.67% of cost in normal non-pandemic years appear to be borne by India Co. Next slide, please. If you go from 2019 to 2020, the cost jumped from 4 million to 6 million. And what explains that $2 million of cost is what I argue is actually increased raw materials cost. Cost inflation's been in the news a lot and definitely occurred during the pandemic. So 2 million out of 14 million. So the 14 million system costs borne by US Co and India Co collectively, 2 million of those costs, or 1/7 of those costs, were borne by India Co. And that's pretty consistent with how much costs they bore throughout the years. Next slide, please. So here's how the system works for sales outside of India. And this this map makes a lot of sense, where USCO supplies all product designs, they procure the raw materials and the IP, and then give them to IndiaCo. IndiaCo manufactures those, and then is compensated by USCO at a cost plus 10%. And those goods are all sold to non-India consumers. Next slide, please. Now, the sales in India, this is where IndiaCo is not a pure contract manufacturer, because USCO does the same function on the front end, but on the back end, after the manufacturing of the goods by IndiaCo sells them to Indian consumers. So in a way, they are operating as an entrepreneur, but they do not bear all entrepreneurial risk. They do not have all the R&D function, as I stated before. And these sales, the 5-year average of global sales is about 11.71% of global sales. Next slide, please. In our estimation, the most logical adjustment to this transaction would be to treat IndiaCo as a full contract manufacturer for 100% of the goods. So 100% of the finished goods would be sold back to USCO, not physically, but title would be transferred. And then USCO would, it would be an optional adjustment where USCO would provide the goods to be sold in India, so about 11.71% or 12% of the goods back to IndiaCo to operate as a limited risk distributor. Next slide, please. Now, looking at the comparables, I think the taxpayer sample makes a lot more sense in that their comparables actually assemble equipment, and you see their IQRs between 5 and 17% with median value of 10%. They chose the median value here. I think that makes a whole lot of sense as a perfect way to guarantee, if we treat 100% of the finished goods as going through IndiaCo as a contract manufacturer, we then guarantee IndiaCo a profit even in those down years. So that would compensate IndiaCo for 2019 and 2020, to where IndiaCo doesn't actually face a loss in 2019 and then doesn't break even in 2020. They would be guaranteed a profit. The Indian TPA sample, where they chose companies that design, manufacture, and distribute luxury goods, I think does not make a lot of sense, because IndiaCo is not responsible for design in any part of this transaction. They are responsible for distribution at about 12% of global sales of this transaction, but I think the comparables in taxpayer sample make a lot of sense. Next slide, Enrique.
Thanks, Brandon. Next slide, please. So in this transaction, IndiaCo is providing R&D services to USCO, and the issues that must be addressed are, first, which entity owns the legal and the economic rights to the IP of the group? And second, is IndiaCo a mere R&D service provider, or IndiaCo's R&D efforts are a mandatory function that deserves economic rights to the IP? Next slide, please. And in order to address those issues, it's important to make a distinction between legal and economic ownership. This is because the mere legal ownership of the IP is not sufficient for determining the IP ownership. So we need to analyze the economic substance of the transaction to determine which entity has the economic ownership of the IP of the group. Next slide, please. According to the OECD guidelines, we need to conduct a functional analysis to determine which entity has the economic rights to the IP. And this analysis includes understanding what are the economically significant intangible assets of the group, who bears the significant risks related to these assets, who is responsible for exercising control over these assets, and finally allocating the arm's length return for the owner of the intangible assets. Next slide, please. According to the facts of this transaction too, USCO owns the legal ownership of the IP according to the intercompany agreement. All the R&D risk is absorbed by USCO, as will be demonstrated in the next slide. And IndiaCo's R&D center works under the direction of USCO's R&D team, which illustrates that USCO has control over the IP of the group. Next slide, please. By analyzing the summary financial data of the group, specifically regarding the R&D costs, it's possible to identify that between 2017 and 2019, IndiaCo's R&D spending average was 14.32%, or roughly 1/7 of the global R&D spending of the group. In the same period, the data shows that the average of the global sales that occurred in India represents 12.42%. So the percentage of global R&D spending is roughly the same as the percentage of global sales that occurred in India, which might make us conclude that IndiaCo is absorbing 1/7 of the global R&D risks and functions. However, between 2020 and 2021, IndiaCo did not have any expenditure with R&D costs, which demonstrates two things. First, that IndiaCo's R&D function for the global enterprise is optional and supplementary. And second, that IndiaCo absorbed none of the R&D risks during this period. Therefore, we concluded that IndiaCo's R&D function is a service to USCO, and consequently, IndiaCo does not deserve any economic rights to the IP. Next, please. So lastly, with regards to the comparables, we agree with the comparables used by the taxpayer because they selected companies that also provide R&D services and exercise similar functions and bear similar risks when compared to IndiaCo. Thank you, and we can now proceed to the next transaction.
Next slide, please. Thank you very much. Well, the third transaction regarding the brand and marketing IP license. Well, we know the fact that taxpayer already explained it. USCO licensed the trademark to IndiaCo, and IndiaCo sell to the local market and gives the profit of the sales of the local market and pay a royalty to the USCO of 4%. Next slide, please. Well, there are a lot of issues that we see in this transaction. The first has to be with in this summary of financial data, we realize that the cost of marketings are all in major being bear by the US company. And IndiaCo has marketing costs remain constant from 2017 to 2021. And while USCO drops substantially the cost during 2019 to 2021, India maintain this level, and this suggests for us that in which part the drop of the sales in India are actually produced by the fact that the US company bear less cost in marketing. Next slide, please. Then we go to the functional profile, and then we can see that actually USCO bears a lot of the rest that has to be here with marketing, product development, and a lot of other issues that relate with the marketing. And then next slide, please. And risk and asset, again, we see here that the market risk is mainly bear by the USCO. The only difference here we have in risk associated with, I'm sorry, that was in the previous one, but okay, it's the same. But the specific tailor market for the Indian market. And then next slide, please, is where we have the main issues regarding to what the Indian tax authority is proposing. First, because the profit level indicator that they choose is the operating profitability is not split, it's not tailored, it's not properly benchmarked. If we are stating that actually the Indian market requires specific tailoring, the comparables should indicate this, but we are using global advertising companies, not specific to the market, and we are not specifically saying how much is the market tailored. And finally, what has to be with the IQR, we said that the taxpayer is choosing between a 5% to a 15%. I'm sorry, the Indian tax authority is between a 5 and a 15% with a median value of 10%. But as the taxpayers say, they choose to a 1% that we don't know where it's coming from. So we think that this transaction regarding to the taxpayer, it's better explained, it chooses better comparables, and the interquartile range is better suitable for the transaction. You can go.
Okay, I'll talk very briefly about transaction 4. I know we're pressed for time, but basically USCO is charging IndiaCo for management services, which we understood to mean strategic procurement, brand positioning, and general administrative services at a 10% markup using the CPM, the comparable profit method, and comparing 10 US companies in the advertising, logistics, and brokerage industries as points of comparison using the median value of that IQR. The India TPO did not chose to decline to prepare a comparable analysis. But basically, if you move on to the next slide, you can see that USCO is performing substantially all of the supplier development, substantially all of the advertising and promotion, substantially all of the sales strategy, and part of the IndiaCo's justification for disallowing the local tax deduction was that these services were duplicative. We sort of take the position that kind of akin to transaction 2, where IndiaCo's R&D team is operating under the direction of USCO's R&D team. A lot of these services are sort of supplemental to one another, and they're not just because IndiaCo has more staff. It doesn't mean that any of the work that's being done is identical, and both companies are sort of both entities are sort of operating in tandem to achieve positive outcomes. USCO is managing the relationship with the suppliers and negotiating contracts, and IndiaCo's staff is likely executing them. And then just with regard to the comparables, even though the industries are not exactly the same, under the TNMM, the standard is broadly similar for the transaction, and a lot of these are very general, services that are being provided, and we think that because USCO chose the median of that IQR, it's a fair point of it's a fair rate of markup to be paid. Thanks. Sorry, I didn't move through the slides. I was trying to move quickly, but my conclusions are on the next page. And yeah.
All right. Well, thank you, Michael. Thank you, U.S. Competent Authority team. We'll now hand the floor to the India Competent Authority team to articulate their negotiating positions.
Okay. Good afternoon. I will give you an overview of our position, and my colleagues will go into more detail into each transaction. So I will talk briefly about what this case is about and what it is not about. This case is not about what percentage of the group's cost is borne in India. It's not about what percentage of the activities that India is doing is routine. And it's also not about recharacterizing the product flow into a different transaction. What it is about is focusing on the valuable intangible that is created and enhanced in India, focusing on the strategic decisions that are taken in India, and also the risks that are undertaken in India. Next slide, please. So this is an overview of the 4 transactions. For the manufacturing services, we're of the view that IndiaCo is a full risk manufacturer, and here we focus on the operational risks that IndiaCo is undertaking, and also the control that IndiaCo is exercising over those risks. In the second transaction, R&D services, India Audit has conducted its own functional interviews, and I quote, it learned that IndiaCo is developing sustainable manufacturing methods that no one in the leather industry has attempted. And since IndiaCo is developing this new manufacturing process, there's an embedded intangible in each product that IndiaCo is manufacturing, and we are of the view that US should pay India for each product that it sells a royalty for the intangible. For the brand and marketing IP licensing, India is its own market, an emerging market. USCO may be providing support for the sales that are done in India, but the success of the group in India is entirely dependent on IndiaCo's team promoting the brand, developing customer loyalty, and also the other important marketing functions it's doing. And for management services, this is not about a markup being within the interquartile range. It's about applying Indian law and also similar rules under US law that duplicative services should not be compensated. Next slide, please. And this is our position of the India Competent Authority. The first row for for each transaction is the taxpayer's filing position. The second row is the initial position, the assessing position of the India audit, and the third row is what we're proposing under MAP and under APA. Next slide, please. And this is a summary of what our proposal will result in. So in the first few rows, those are the transfer pricing adjustments by India audit, resulting in $29 million in adjustments over 3 years. And if we're projecting for years that are not yet under audit, namely 2020 and 2021, using the same assessing position as in 2019, this is the result. It would yield almost a bit more than $10 million of tax in India. What we are proposing is summarized as a reduction to $20 million of transfer pricing adjustment, resulting in a bit less than $7 million in tax in India. And this represents a decrease of 68% in the transfer pricing adjustments. And we would submit that this is a reasonable position and it should be accepted by the US team. Next slide, please.
Okay, so for the first transaction, we don't consider India as only a contract manufacturer. It's more like a full risk manufacturer, because India actually owns the production facilities, hires and manages the employees. We have to take into account that the workforce in India is 1,500 against just 200 in the US. India also has the know-how of the manufacturing techniques and develops the new manufacturing techniques as well. And with respect to the domestic market, India is actually a full risk manufacturer. India bears all the risks for the workforce, for the production, marketing, inventory, and fixed assets. As we know, for the fixed assets, we didn't have full capacity for neither of the years. We only worked at 75% of the capacity in one of our India's complex, and the other one was just 85%. And we also develop high R&D, so we also bear R&D risks. With respect to the sales to the US, India still bears the risk for the fixed assets and the substantial production. Other evidence of that India is a full risk manufacturer also comes with COVID. India had a loss of 40% versus a 22% loss in the US. If India was only a contract manufacturer, then most of those losses, will be absorbed by the US, which didn't happen. And for the transfer pricing method and the comparables, well, what happened here? Okay, well, the comparables used by the taxpayer are not suitable, as they are not from the luxury goods industry and they're not from India. India offers a premium, which is the cost of the workforce, that is not taken into account in the comparables used by the taxpayer. So we used a sample of 6 Indian companies that design, because as we show, R&D is imbued in our products, manufacture and distribute luxury goods. Next slide, please.
Thank you so much. This transaction is specifically important to us because we have to address something in this case. What you're saying about the R&D in this situation is what everyone says it happens in you have a US company or a foreign company, we come here, risks are not assumed at all, and in India, they're only the manufacture process is going on. Because of that situation, in India, we have a very specific approach. We receive the information, we send our people, and we see what is actually going on in the factories. And we found out something that has not been addressed today. There are people that are conducting relevant IP development in these faculties. We have auditors that have gone there and that confirm this information. So do we think that India Co is only a contract R&D? From the facts, we do not think so. From a legal support, we also have standards to reassure this and come to a fair conclusion. And circular number 6 of 2030 give us 4 factors that we have to determine if this is actually a contract R&D. First, the foreign company has to perform most of the significant R&D functions. As you have said, not here. Foreign company must provide capital and assets for R&D as well as remuneration. As you have said, not here. Company must directly supervise control on R&D. This is the part that we have concluded that is not here. The Indian company must have no significant risks in reality. As we have seen in the market, it's not here again. And Indian company must have no ownership rights over the outcome of the research. This one is one that we would like to discuss more. Because of this situation that's on the transfer price, we have used a sample of 20 Indian and Australian electronic companies. And we believe that a royalty of 5% of the sales of US Co would be fair on the assumption that, as we have seen, India actually performs an added value on this transaction. Also, we're open to discuss on the method, because since we are saying that India could perform more functions than the ones that seems to be in the paper, profit split method would be more representative of the nature of the transactions. Next slide.
As for the third transaction, we think that India is actually paying way too much for what the US is contributing. Why? Because India is its own market. We have different trends. We have a team of 20 designers that are actually creating the market-specific marketing for India. And that's producing over 10 million in domestic sales. So really the brand that the US is giving us, it's just not enough for what they're charging. US only takes a routine advertising functions here, as they're only providing supplies and basic templates, but they're not actually contributing enough for what they're charging to us. So what we used was our comparables are 6 large global advertising companies, and we determined that based on that, India should be paying no more than 2% of the brand royalty to the US. Next slide, please.
Lastly, and I want to refer again on the evidence that we've gathered from the business student faculty, we have seen that India Co actually has a team that performs the functions that of related to manufacturing, marketing, management, and because of that, what is being presented on the financials is duplicative. As Wade said before, we have to base ourselves on the law on this, because we're talking about allowing or not a deduction. And we found common ground both in US transfer pricing regulations and Indian tax law regulations on the matter that says that in these situations, if there's no benefit, if the services are duplicative, the deduction should not be allowed. Because we found common ground in that situation, we truly believe that it's very fair to say that the deduction here should not be allowed. But since we recognize that US Co also provides procurement services and IT systems management, we're willing to negotiate the allocation of direct costs in this administrative services up to 25%. Next slide, please. As you can see, because of this situation, because of what we've gathered in the ground, we had to do all the analysis again on what is actually going on, and we've presented a functional analysis saying without representation of what India Co is actually doing. As you can see, India Co is actually bearing risks on their analysis on the in all the sales that they're does in India and in the IP process too. And in the next slide, please. We have more information that represents what we believe would be a fair assessment on the true essence of the nature that is being conducted in India. Next slide. To conclude, in India, we have a long maintained history of realistic expectations. As we had said, we're really want this negotiation to come to a very good point. The problem is, as we've said before, that this is something that happens on a daily basis. And because of that, we just want to be thorough and want to be fair with what's really going on in the transactions that are here. And because of that, on the points that we've taken, we're really looking forward to hearing your comments to explore more. And like I said, find a common ground that gives the taxpayer a fair result on what's really going on. Thank you so much.
All right, thank you, India Competent Authority. So, the gauntlet has been thrown by all parties. So we'll now take a break. Those of you on Zoom, you don't really have a breakout room, so you can just turn off your camera and your mic for 15 minutes. and rejoin us here, please do, for the fireworks, the negotiation session after this break. So 15-minute break for you out there. For us in here, gonna move to our breakout rooms, taxpayer and competent authority teams and experts. Let the coaching begin. Make your way out there and, you know, comfort break also. Okay, welcome back. We have completed our negotiating prep break, and now we're going to launch into negotiation. So, and click the next slide. It's very descriptive. We will let you all begin. So I think maybe so that this doesn't end up as a shouting match, people talk over one another, I will let the U.S. Competent Authority team, why don't you start? But this should be an exchange. So let's get some back and forth and, you know, see if you can get to a deal.
You may want to think about this on a transaction by transaction basis to negotiate it out, or holistically, but let's set some ground rules on how you want to both approach this.
Transaction.
Yeah, I think
Yeah.
transaction by
Yeah.
transaction. Yeah. So I guess transaction one.
Yeah. let's
Okay,
go.
so transaction one, I thought your presentation focused too much on the percentage of global sales that occur in India to conclude that 12% of the sales should govern 100% of global profits and costs. I think is operating from a pretty weak negotiating point. I don't think that IndiaCo is a full risk manufacturer. They're not exposed to entrepreneurial risk for, you know, over 88% of global sales here. So I think it's very important to bifurcate those transactions and to try to recharacterize the transaction in one of two ways. One way would be the way I proposed, where everything guarantees IndiaCo a profit, you know, everything is contract manufacturing, and then IndiaCo could be a limited risk distributor and just increase the markup on the contract manufacturing to compensate IndiaCo for its limited risk distribution function. And or we can actually bifurcate the transactions and say that, at least looking backwards, 88% of global sales should be treated as contract manufacturing, and then 12% we would be willing to concede should be at least something approaching full risk manufacturing. And if we do the math, it would be something like a cost plus 12% markup. So we would keep the contract manufacturing framework, but just increase the markup. Either way, I think we're increasing the markup on contract manufacturing and not recharacterizing the transaction and saying that IndiaCo is the only entrepreneur in this transaction.
Okay, can I ask how much you're willing to increase that markup to?
I think cost plus 12%. Either way, we recharacterize the transaction. Going from 10% to 12% is very reasonable. And if we recharacterize it as full 100% contract manufacturing, it guarantees IndiaCo a profit even in the 2020 year.
So I was wondering where you got the idea that they have no risks in the US Co transactions. They do have issues with keeping their employees. They have a lot of issue with employment. And they obviously, you agreed that they have all the risks whenever it comes to actual like assets. So I just wanted to know what factual basis you're relying on the no risk idea is coming from.
I'm not saying no risk. I'm saying they have a risk of a contract manufacturer. So a contract manufacturer in an unrelated transaction would have some cost in fixed assets that actually manufacture goods, and they would have labor costs, but they should be compensated with the cost plus under a CPM for those risks that they do assume.
Okay, and then I know that you said you're willing to compensate for the risks that it has as well in India, but in India they bear the majority of the risk, and obviously we don't have the contract, so we can only base off of economic reality. We can assume all day long what we may have contractually agreed to, but at this point they do have quite a bit of risk in India, so we would ask for a higher markup. Our starting is obviously 35%. We are willing to move down, but not to 12%.
Yeah, I would say the 35% from your comparable set, all of those comparables were full risk manufacturers that design, manufacture and distribute. And I think that's completely unreasonable, but there is some wiggle room in here to make sure we come to an agreement. But I think I wouldn't be willing to even approach 35%.
Okay, would you be willing to approach more of our medians around 25 or 27%?
No, I don't think that comparable set is something we can rely on at all. So I would be willing to increase above the median for the comparable set that the taxpayer provided.
If we could do, is there a possibility that we could do 27% for the map, but then go no risk for the APA? So we can contractually agree to no risks going forward. However, for the map procedure, 27%.
Again, I think that's too rich. I think at most we'd be willing to go a few to 3 to 5 percentage points above the current markup. So what about cost plus 14%? You know, we recharacterize the transaction to where Indiaco's guaranteed a profit, but they're not going to be subjected to losses going forward.
I think 14% is still too low because you're arguing that they are not full risk. And while I may agree that they're not completely full risk in the US coast sales, they are pretty much full risk for the India sales. And you disagreed with our comparables because they design, manufacture, and distribute. In India, they design, manufacture, and distribute.
I would disagree that they design in India.
Okay.
And I would also, and I think focusing on the R&D spending specifically in 2020 and 2021 demonstrates that they aren't bearing all the R&D risk because the R&D spending drops to zero. 2020, 2021, Indiaco is not bearing any of the risk for R&D. I think that's a perfect test case there. Yeah, so I don't, and I wouldn't even characterize the 12% of global sales that occur in India as full risk.
Okay.
I think they do assume more of the risk, and I think that could be pointed out by they assume about 1/7 of what I'm assuming is raw materials cost, but we don't know because the slide deck isn't perfect. But I would say 14% probably would be about as high as we could go. But maybe we should move on to different transactions.
Let's do what your main issue seems to be is the designing. So let's move to transaction 2.
Okay.
We would like to do that. We do designs. We developed sustainable manufacturing process. I know that you said that it goes down to 0% in 2020 and 2021. However, that manufacturing process has already been developed. It is already an embedded intangible in everything that we have. And everything that we send to USCO, and that's why we're asking for the 5% royalty rate. We also design, obviously, the bags, and I believe shoes was the other thing that we designed, but we really are focusing on that sustainable process that nobody else has. We are the developers of that. So is there a reason that you are unwilling to pay for that royalty?
Enrique, do you have a response?
Yeah, I think we just don't agree that Indiaco has any economic rights of the IP. So I think that paying a royalty % for non-India sales would not be the better method to apply here. We understand that Indiaco plays an important role by developing the designs of new products, but this developing activity is made under the supervision of the US co-R&D team, which is the entity that owns the economic rights to the IP. So maybe we would be open to accept a higher cost plus percentage under the CPM method, provided that this percentage is within the interquartile range of the comparables presented by the taxpayer.
So I do want to speak about the fact that you think everything is under the US direction. As the Indian Competent Authority, we often take the position that there is very little capability of putting anybody in a foreign country so far away under the direct control or the direct management of a foreign company. And so we disagree that you like it was all under the US direction, especially given the amount of employees that we dedicate to designing. We are willing to go down on the 5%, and we were willing to go down to about 2% if we can stay with the technology royalty.
I want to pipe in here. I agree with Enrique, and I think that 2020 and 2021 and this transaction specifically are very important. The fact that IndiaCo's R&D spend under the direction of the US Co goes down to zero whenever cost crater, I think is a perfect test case of who is actually assuming the R&D risk. And so I think the taxpayer giving away economic rights to the IP to a party that the taxpayer doesn't think has economic rights to the IP, I think that would be too rich, because what if the taxpayer opens up whole new markets and the percentage of India sales goes down to 3% of global sales? All of a sudden, IndiaCo is getting compensated for 5% of global sales that are occurring in all of these different markets, these new markets, when IndiaCo is contributing nothing to R&D in 2020 and 2021. And every other year, they're contributing percentage of cost to R&D, but it's under the direction of US Co. I do agree that IndiaCo's contributions are valuable, but I don't think they are assuming any of the R&D risk there. And I don't think it's a mandatory function.
What we're getting an impasse here, and it's something that I think we were very clear and we're not touching again, is that we're talking a lot about what we think the IP is value. We're talking about what we think is going on in India. But what happens, what we found is going on. We have factual information that says that we found people working on the IP and adding value to the process. And in all these assumptions, we're just saying, oh, what we're seeing here is actually not true. So what we've been asking, I think, and this is come back to your position, is to come to a conclusion here, we have to face ourselves first from the facts, because since we don't have contracts as US law provides, we have to go through the economic systems of what's going on here, and then conversate on what can we agree on and what.
Sure, and I agree. In your presentation, you said you visited the factories, but I didn't see those facts in the slide deck. I didn't see where the India TPO went and confirmed that IndiaCo was serving a mandatory R&D function. All I see is that their costs drop down to zero when the global R&D spend drops down.
Yeah, can I just
Yes.
say? So according to the facts provided, the excerpt from the company 2019 section 6662, the 100% of the R&D risk is supported by US Co, and 100% of the production risk is supported by US Co. And in the last 2 years, just US Co spent costs on the R&D. So I cannot see where IndiaCo has a right for the intangible property here.
I will agree.
According to the facts.
The taxpayers' FAR analysis did say that. However, that's from the taxpayer's point of view. So of course it's going to say that. We are coming from the position that they did develop this manufacturing process. And while obviously embedded intangibles depreciate in value. So we are willing to negotiate this as well. If you're willing to step back into MAP at 2% in MAP for each year, 2017 through 2019, and then 2020 and 2021, which you have pointed out, we did not pay anything in research and development. We can negotiate a no percent and keep with the markup on cost.
And then moving forward.
Yes.
Okay. I would agree on 2017 through 2019, 2%, 0%, 2020, 2021. But going forward, I do not think giving IndiaCo credit for the economic rights to the IP. I think more of a cost plus markup would be the way to go there.
That's fine. We can stick with the original cost plus markup if that's the way you would like to go, which was 15% for going forward.
Yeah, going forward.
Yes.
Okay.
Okay.
All right, so transaction number 3, the brand and marketing IP. I think that it's very clear that the Indian market is not the US market. Yes, the US market has the rights to this brand name, but Indian market is very different. It has its own movies, its own TV shows, it has its own commercials. It is not the US market. And no matter how luxury your goods are and how nice they sound, without any kind of advertising done by IndiaCo, nobody in India would be willing to purchase these items. And that's $10 million in IndiaCo's profit. So I am less willing to bend on this transaction. I believe that you do provide some, and we did go down in ours from the TPO, and we also are at the median for your comparables. So we would like to stick with the 2% royalty rate.
Well, first of all, we actually agree that the Indian market is different, is specific, and requires a tailoring of the marketing for sale. But not all the sales are actually because of this specific and tailored marketing. A lot of investigation about the specific of the market has been done, and you can identify two different kinds of consumer. A traditional consumer, which is related precisely to what you say, to the tailor marketing, the tailor and the specific related to their culture and their market. But you still have an important percentage, which is the called novice consumer, which is a person just like in everybody else in the world that goes strictly for the brand. Just for the brand put in the bag, in the handbag, or whatever the product it is. So our position is that we believe that there is a specific market, but that is still not reflected in the analysis that the competent authority is done. Why? First, because the PLI choose is not benchmark. We don't see what you are just saying in your analysis. Actually, the comparables that you choose are global advertising. They are not consistent with what you are just saying, the specifics of the market. And still, your royalty doesn't have anything to do with your explanation, because your interquartile range goes from a 5 to a 15%, and you are going to a 2%, which it is within our interquartile range, supported by the information and the facts provided by the taxpayer. So our position regarding to this will be willing to go to the 2%, but only if we agreed in the rest of the transaction as proof of our willingness to get an agreement.
So tentative agreement.
We are not willing. We are not willing to agree to the rest. We're not willing to concede on the rest. Our 10% markup is on the 10% range is on the markup. It is down to 1% if you apply it on the markup. And then so it is within our interquartile range. And then also the fact that it's the median value, whereas you have it at almost the max, value, the taxpayer has it at 4%. I think the 2% covers your traditional and non-traditional consumers, both those that are obviously only purchasing because it's been properly advertised in India and curated for India. Whereas obviously luxury goods do have names out there like Gucci and things like that, right? So we all know who those are. However, I think that the 2% covers the luxury brand type royalty. And like I said, we're not really willing to negotiate on this point.
Do we want to stick to
We
a tentative agreement to move to the next
Tentative
round?
agreement and come back to this.
Okay.
See if you can reach a deal on all transactions. So
Well, transaction for our law is the line, right? We don't give deductions to duplicative services. So do you agree that except for the two that are not duplicative, namely procurement and IT management services, the rest are done in India by both India Co and US Co. And since they're duplicative, then there should be no deduction allowed.
Michael?
I think the extent to which they're duplicative, it really depends on, just because they're the same type of transaction or the same type of service that's being performed doesn't necessarily mean that both entities are performing identical work. As I said during my presentation, it's very likely that this is supplemental. I don't think either entity can really operate without the other in this circumstance. And US Co is doing all of the sales strategy and all of the pricing. I mean, I don't understand how you can argue that it's duplicative. If that's the case, it seems like US Co is really taking the lead, and India Co's teams are supplementing it. And a 25% allowance or 25% allowance for the deduction just seems quite low given the context.
You state that USCO has all of the strategy. However, IndiaCo chooses how to apply those prices and when to apply them. And that in itself is strategy. And the fact that we are willing to give the 25% for the extra services that you do provide that are not duplicative of the services that IndiaCo provides. However, it can't be said that they don't overlap at all.
I wouldn't say they don't overlap at all, and that's why I'm not saying that there should be, you know, a 100. The deduction allowance shouldn't be, you know, 100%. But I would say, like, for example, just with regard to supplier development, I mean, without USCO, the IndiaCo doesn't have suppliers, doesn't have relationships. I don't understand. I think 25% just seems quite low. I understand the concept that IndiaCo is doing some of the direction of the sales strategy. It is making decisions, but I don't think that this reflects the distribution of labor across the two.
I also want to point out, though, that all of the suppliers are in India. And so we could easily, IndiaCo could develop those strategies. And there's nothing to say that procurement is not based on a relationship within India or the fact that IndiaCo is an Indian company.
I think there's truth to that, but I also think that would be, if IndiaCo had relationships with those suppliers, I think it would be reflected in the FAR. And I think it's all well and good to say that it could develop those relationships, but the fact is that it doesn't. And I think there's a reason why USCO is involved in those circumstances. I think it probably has personnel that are better suited to negotiating those contracts and developing those relationships. And I think there's a reason why. So I think 25% is too low. I'm curious as to what your flexibility is on that number.
Okay, we already agreed that they overlap. So what will be your proposal? We already proposed 25% of deductions.
Michael, can I?
Go ahead, Brandon. Go ahead.
Percent of the deductions.
Can we settle at 50?
If we settle at 50, I'd like to do some horse trading. So let's say we settle at 50. We say it's so 50%.
This never happens in real life. No.
Yeah, let's say we settle at 50 there. Then
maybe
I'm trying to keep all of that to a minimum.
then we settle at cost plus 13% in transaction one. And something else I want to point out in transaction one, if we recharacterize the transaction to full contract manufacturing services with all the goods then being passed to USCO and then back into the India market, there's some sales tax that will also come into the Indian coffers, I guess you could say. So 75% or 50% deduction allowance on transaction 4, cost plus 13% on transaction 1, and a 2% royalty on transaction 3, with our before agreed on transaction 2.
Can we negotiate at a 15% markup on transaction 1 for the math years, and then 13% markup on transaction 1 for the APA years, and then we will agree to your percentage or 50% for transaction 4.
We could change that to 14% on the map years and 13% prospectively for the APA years.
I think we've negotiated quite a bit down on that, actually.
But again, we're talking about 90% of global sales that don't occur in India. That IndiaCo definitely operates as a contract manufacturer. So I think we've gone above and beyond with the 14% markup for those map years. I think that's actually it's above what I was prepared to go to beforehand. So you guys have done really well.
Okay, so what was that? It was 14% for that, and then
13 for
I think if we are guaranteed that we're not going to take losses for 2021,
yeah,
I think it's reasonable.
Okay, yes, we'll agree to that.
I think we have a deal.
Yeah, except for transaction. We're not going to agree on that.
So now, just to make sure that I have the terms right, we're proposing this to the taxpayer, and it's a yes or no. For contracts for manufacturing, under the MAP, it's cost plus 14%, and then into the APA years, it is cost plus 13%. Yes. Okay. For the let's see, for the brand royalty, did we agree on 2%?
Yeah.
For 17 through 19,
and then-
0%, 20 and 21.
But we're keeping the markup that they had already, which was
15%.
15%. Yeah.
Okay. And then I think on management services, a 50% deduction allowance. And then what was the other transaction? The brand royalty was contingent, but that was going to be reduced to 2%.
Yes, but I don't think we met the contingency.
No, I think
No,
you
no,
agreed
no,
everything else.
We did, okay.
Yeah, we were
Okay.
everything else.
Okay.
So is that acceptable to the taxpayer? Or do you want to litigate?
I think right now, looking at our options, and I'll of course defer to my colleagues on Zoom, but whatever, like from the interactions that we had, whatever dollar that goes to India extra, I mean, India is 34% and the US is 21%. So that gives us like 13% differential. And we assume this has taken a lot of time and looking forward into litigation, that will also take more time. And from the position that the Indian authorities have put forward, we're also looking at, I mean, maintaining relationship going forward. And if I'm speaking for my team, you guys can feel free to chime in. I think we would be willing to accept the proposals and the agreement that has already been reached.
Taxpayer team on Zoom.
And of course, considering the fact that we would be getting a deduction for whatever we pay in India from the US. So I think it's not the win we anticipated, but it's a win still.
Thank you. Should we ask, we'd really like to hear from our expert panel. Do you think they're negotiating, and what have you seen in the real world? Maybe Pat, we can start with you.
This was good negotiating. And it was interesting to, important to separate the APA years from the MAP years. Because you don't have a lot of knowledge of what's going to happen in the APA years. You don't want to go to litigation. You made the right choice. I've done litigation in India and it's still going on.
In 1 year, that's totally done.
So that was smart. What other, oh, the one thing that occurred to me is, I think it was in your materials, is there are safe harbors in India for various kinds of transactions. And they're fairly limited in sort of the scope of them, which are what kinds of transaction they cover, and also in the dollar amount is pretty small, but this is actually a pretty small company, this one. So that could have been a useful way to think about some of the transactions. For instance, the cost plus on contract manufacturing ranges, and it's only in the automotive industry, but from 8.5% to 12%. So, you know, getting to 13 to 14%, you gave up your safe harbors. and the administrative services, of course, was 5. So this, I think, in the real world, the taxpayer would probably make more of the safe harbors, defensive or offensive. But I thought it was really a good negotiation. I thought that was very impressive.
Completely agree with everything Pat said. I think one thing I'd like to say is my only disappointment in this project was the time limit. I wish we could have done this whole thing. No, seriously.
That's in real life.
It was really good. Kudos to you guys and your mentors. You guys did an excellent job. It does my heart glad to see folks learning about the MAP and APA process. In my humble opinion, taxpayers don't think about it enough. So to see the next generation of tax practitioners learning about it, it makes me very, very happy. I thought your negotiation was very good. I thought your use of the facts or excellent. One of the things, and again, this probably isn't your fault, kind of looking for contract terms to look at some of the manufacturing, the management services and things of that nature. Is something there. I really like that you guys came up with the royalty for the know-how. We talked about it on the side. I think that was a massive win for you guys when you kind of do that math for the map years and kind of saying, okay, we'll take that in the map years and compromise the APA years, while kind of leveraging that to completely de-risk your entity. I thought was excellent. Again, it was the India team. I thought was far more reasonable than the Indian USCA team is typically. One thing that I liked that all the teams did was you kind of looked at the as filed position, and you looked at your the US team looked at the as filed position and made some compromises before going into negotiation, and India did the same. I think that's really important as a act of good faith to kind of say, look, we looked at what our teams did, we looked at what our sides did, we're not going to be greedy. We're going to go in and kind of take some of the easy issues off the table. I thought that was great. I like the tactic of saying, listen, we'll give you the 2% if you agree with something else, and now we're going to hold on to it. That I thought was good, because I think the 2% as a trademark royalty is very reasonable. So if you say, okay, that's what you want, I'll hold it against something else. I thought both sides did that nicely. And for the taxpayer team, recognizing the nightmare that is potential India litigation can't be understated. But yeah, I had a lot of fun listening and talking to you guys, and excellent job.
I agree with my friends. It was well done. I'm going to take the opportunity, rather than go back over the back and forth of the negotiation, to talk about, if this had been closer to real world, what are some of the other things you might have gotten into? And no particular order. And again, this is not criticism, it's just you didn't have the facts. One of the things we were talking about, 4 different transactions, and the ability to actually segment the data, to actually look at each of those 4. This was a hypothetical, it's what you're doing. One of the real world issues you're going to be coming into is your data may well be flawed. You may have 4, you're going to have 4 transactions, but whether you can look at them the way you did, or what you're going to have to do to break down the data to have that be meaningful, it's more than just an academic question. At least it's a practical nightmare. You mentioned the contracts. I want to emphasize that, because we're all prone to throwing labels around, limited risk, whatever. You can't know really what the risk is until you read the contracts and what the terms are. You might have circumstances, they do come up, that basically some manufacturer is guaranteed to get paid no matter what happens. That's about as low risk as you can get. Your contract may not be that way. And again, for the exercise you have here, well done. Going back to the real world, start with the contracts. And it may well make sense not to litigate, especially in India. But what we have here, the time limit, fine. But what do you think the US taxpayer really might be doing in a situation where the competent authority has come back and said, this is the deal? Well, one thing you're going to be doing is calculating what that's going to cost you, what your tax rate differential is going to be, what this 13% spread is going to come to, what it's going to cost you. You're going to figure out also what your reserve is against that. How well you anticipated what may go on, and whether someone's going to be saying, great, we're more than reserve. In fact, we got an extra reserve. Well done. Or whether someone just be saying, well, we're not reserved at all, or where in between you are. And cumbersome, dangerous though it may be, how much it does cost. Again, we got to exercise here, but I hope that some of the practicalities of actually making that decision, not in our 5-minute exercise, but actually when you're representing a client and coming back, some of the things you might be thinking about.
Can I add 1 or 2 more?
Please.
Just you made me think of some real life things, Howard, in terms of what you have to prove. On the R&D thing, which I know was very important to you all, we had one case where it involved R&D and licenses. And the Indian tax authority looked at every single patent that the US had obtained to see who the inventors were. Because when you file for a patent, you have to show who did the, who thought it up. And if they found any Indian people, we were dead. And they went through hundreds. It was excruciating in terms of that. The other thing, this goes to something Howard said about looking at the contract. One of the APMA directors, Matt Frank, often went and talked about what he called the Heisenberg principle, which is if you price a transaction a certain way, does that change its character? For instance, if you take a distributor and your agreement says, we're going to pay the distributor cost plus 15. That distributor has no risk. But is that really, have you just by pricing it, have you changed its character? And it's often a conundrum. Here in the R&D, I mean, you charged cost plus whatever it was, 15%. Was that enough to de-risk the contract manufacturer or not? You can go in circles even with an agreement. And I think most of the commentators take the position that you can't look at the price and pricing terms in your agreement because that proves too much. Anyway, those are just sort of real life observations that we're going into, particularly with
Can I jump in with one other? And again, maybe this is at the margin, but in talking about the procurement, we've got the US procuring 100%. And again, good back and forth about who's got the relationship, could they be established? Well, there's also one practical thing's coming up is volume and discounts. And right now we've got the US buying 100%. And who knows what the facts really are, but you might find in the real world when you say, well, India could go establish its own relationship, but even if it could at some point, would India be getting the same price as it would be getting when the US is buying in bulk?
I have one question. In this case, if the taxpayer agrees with the agreement, does it risk penalties in India? Or do they usually, does the agreement also say, okay, you're not going to risk any penalty if you agree with this?
My experience is India always proposes a penalty and always concedes it.
Or there's another way of saying the same thing, it's all negotiable.
But their law is fairly strict on when they have to impose a penalty, as I recall.
Yeah.
But they
Sorry
give it
to
up.
interrupt,
No,
I'm
please.
under litigation, we do. But there is a lot of times that they do issue a 20% penalty upfront of their original assessment, and then you start negotiating as phases progress. But I'm not sure exactly the proceedings that we're discussing here. But they do have very strict penalties and assessments. That around 20%, you always have to put that down in order to be able to discuss further.
But to Howard's point, it's a good question, not just with India. If there are penalties and interest up front, you want to understand how that's handled before you sign a map agreement. Because you don't want to sign a map agreement and say, I accept it, and all of a sudden, your letter says you have to pay all of these penalties. So it is a good question, something you should think about before you get to the room.
Again, one of the other practicalities. So here we're going into something where the US, part of this is going to it's going to owe India some money, maybe getting a refund from the United States. I hope you as taxpayer, you've kept your statute of limitations open to claim that refund.
And I would add that if it went the other way, India would never give you a refund. I'm serious, their law doesn't permit it. So in your APAs and so in your APA years, you've always got to err a little bit on being whatever direction it is, it doesn't get you into a need to get a refund. And that can be very challenging to try and get the number right.
And that question actually came up in our session saying, well, if we're doing an APA for 21 and 21's already passed, is that too late? I think that's what Pat's touching on here. You think about your filing position and you think about things like telescoping and moving and adjustment, so you don't have to deal with the issue of filing those.
I know telescoping, do they?
Yeah. What telescoping is almost all the time when you sign an APA, you will have some past years. So your APA is typically 5 years, year 1 through year 5. You start negotiating in year 1, typically, you hope you're done negotiating at some point before year 5. But say you agree in year 3, you file tax returns for year 1 and 2. So you have a couple options. You can accept the APA, file amended returns for those years, but then you run into the issue Pat's talking about, will the local jurisdiction give you back your money? Or what you can do is to negotiate with the competent authorities to have all of the adjustments in the year that the APA is signed. That way, the past returns stand on their own, and you only have go forward, as you can imagine, less risk of interest and things of that nature. But there are other issues with telescoping. You think about, what are the domestic tax rules that could impact, filing amended returns or taking the adjustment. Now, what are your tax attributes? A big one that actually came up in the US is TPj. Tax rate change, right? Yeah, so your tax rate in the past is higher than the tax rate now. So, and I think APMA even came out and recognized that there could potentially be some gamesmanship. So they had kind of a general kibosh on telescoping unless you could show that the US business was attached.
Well, mentees, unless you have any specific questions, we are a few minutes past our time. And so I think we're going to have to release our Zoom audience, but we can stick around here in the room. Experts, if you are keen to hang around, I can set up a new Zoom and we can let Marcus go back to his day job. And I'll send it out to the mentees who are collected on screen. So I think we probably have to conclude for today.
I want to check that there's no question that is coming in. So I think those are comments. Okay.
Thank you very much, everyone who is listening on Zoom, all of our participants. We appreciate your coming for our super spreader event, and we will see you again, some of you again, next year.
Thank you.